Vishal, this certainly has been the year of tariff uncertainty. So how will that impact economic growth going forward? What's your GDP outlook?
Quite a bit happening this year. A lot of cross currents, a lot of volatility, a lot of dispersion. But at the end of the day, I think if you look at the first half of the year, pretty strong returns across the board in fixed income and negative correlations to risky assets almost delivered on the dual mandate. Yes, I think August 1st deadline is coming up. We think about tariffs and the uncertainty from that very directly correlated to real growth, GDP, and inflation. Monetary, fiscal policy are the two key determinants. And we do think that, I think in principle, it should be lower real growth, in principle, one-time bump in inflation, but not enough to cause a recession here in the US. So lower but stable growth here in the US.
Will the tariffs pinch earnings? That's what a lot of the analysts on Wall Street are looking for.
Partly, yes. I think either it is one-time bump in inflation, which we did not see today in the print, or it is a margin pressure at some point. So I think in the next 2 to 3 sort of prints in inflation, and this earnings season is going to be one for clarity that we need from the companies on that aspect as well.
Lots of people are talking about valuation in the equity market. But what about relative valuation when it comes to the fixed income market?
So if you take a step back, I think fixed income in client portfolios is trying to deliver on a dual mandate. Mandate number 1 is income and total returns. And mandate number 2 is negative correlation to risky assets. So if you take the mandate number 1, we did a very quick study. We took an investor, invested first of the year in a passive index, and the starting yield of that investment was more than 90% correlated to the next 5-year rolling active return that the investor made. So looking at yield levels today, really compelling opportunity for fixed income investors or investors to increase their fixed income allocation from that aspect. So we are actually quite a bit bullish on active fixed income at this point.
Let's dig a little bit deeper. Where in the fixed income world are you finding those opportunities? If you're running a total return strategy, where's the best places to be? Is it munis, high yield, govies, where?
So I think we dissect the world into 3 big balance sheets: the government, the corporate, and the consumer, which is your securitized balance sheet. And I think you will see our total return strategies basically maneuvering these 3 balance sheets based on fundamentals, technicals, and valuations. Today, if you take that 3-pillar approach, it steers us towards securitized balance sheets. Very strong fundamentals, mortgage bonds backed by mortgage payments, commercial mortgage-backed bonds, asset-backed bonds. That's where the portfolio is tilted, with a good amount of ballast, given valuation from a spread levels are still tight or on the tighter end, if you will. But then good amount of high yield and investment grade corporates. So leaning towards financials, leaning towards single B and double B corporate bonds, because we do think that corporate balance sheets are robustly strong coming into this year as well.
And then finally, I mentioned it before, but I'd like to hear your definition. What exactly is a total return strategy as you see it, and why is this the best way to go forward?
I think it seeks that dual mandate, income total return and the negative correlation to risky assets. I think the key there are 2 key terms, which is active management and flexibility. I think as we maneuver through this year, we've seen already the 10-year, go through 100 basis points of a range. We think that will persist as monetary and fiscal policy are effectuating change or trying to effectuate change. So flexibility and active management, that's what total return strategies give you today. And that's how we are maneuvering through the environment.
All right, well, thanks for coming on and talking about it.
Thanks for having me on.